Economics shapes our decisions every day, from what we buy to how we invest. Economics is with us at all times. But how does this massive system work? In this video, we will explore 5 key concepts that will help you understand economics. If you're ready, let's dive into the world of economics. 1. Supply and demand. The core dynamic of economics. At the heart of economics lies the supply and demand law. These 2 concepts form the foundation of economic decisions and help us understand how markets function. Supply refers to the amount of a good or service available in the market. If supply is abundant, prices typically drop. Demand, on the other hand, refers to the willingness and ability of consumers to buy a good or service. When demand increases, prices generally rise because consumers are willing to pay more for the product. When a product first enters the market, demand might initially be high. For example, the release of a new smartphone model may generate significant demand at the start. However, as manufacturers produce more phones, supply increases, and prices may eventually fall. This balance allows markets to self-regulate. The law of supply and demand is not only applicable to daily shopping, but also plays a key role in larger economic events. For instance, during the COVID-19 pandemic, the demand for medical supplies surged, while the supply couldn't keep up. As a result, the prices of masks and sanitizers skyrocketed. The supply and demand relationship is also known as the price mechanism. Prices help determine how much of a product or service will be produced in the market. For example, if demand for a product increases, producers will want to increase production because higher demand equals higher profit. Similarly, if demand decreases, producers may scale back production and investment in that product. When supply and demand reach a balance, a natural equilibrium price forms. This price allows both producers to cover their costs and consumers to purchase the product. 2. Inflation. The erosion of money's value over time. Inflation is a phenomenon that economies constantly face. Inflation occurs when the general price level of goods and services rises, reducing the purchasing power of money. As prices rise in an economy, the same amount of money can buy less. There are several main causes of inflation, including demand pull inflation, cost push inflation, and money supply. Demand pull inflation occurs when demand exceeds supply in the economy. As consumers demand more goods and services, sellers raise prices. Cost push inflation, on the other hand, happens when production costs rise. If the prices of key production inputs increase, producers pass those cost increases onto consumers, resulting in higher prices. Additionally, an increase in the money supply can fuel inflation. If central banks issue too much money, demand rises, leading to higher prices. Low inflation is generally considered healthy for an economy. However, excessive inflation can lead to a depreciation of the currency, reduced purchasing power, and increased economic uncertainty. For example, Germany's hyperinflation in the 1920s led to people spending their money as quickly as possible, causing the economy to collapse. Inflation rates are typically monitored and controlled by countries' central banks. These banks adjust interest rates and control the money supply to help keep inflation in check. If inflation rates rise too high, central banks might increase interest rates to reduce money in circulation, which helps control inflation. 3. Growth and recession. The 2 faces of the economy. Economic growth refers to an economy's increase in production capacity and rising living standards. Growth happens through technological advances, efficiency improvements, and investments. Economic growth typically leads to more job opportunities, higher incomes, and greater overall societal welfare. The rate of economic growth is usually measured by a country's gross domestic product (GDP). Healthy economic growth is crucial for long-term economic stability. In contrast, a recession is a period of economic contraction. A recession is marked by a decline in economic activity, such as decreased production and consumption, and rising unemployment. Recessions are often triggered by an economic crisis, a global financial collapse, or a drop in demand. During a recession, consumers cut back on spending. Businesses reduce investments, and the overall economy slows down. For example, the global financial crisis in 2008 led to a severe recession worldwide, with many countries seeing high levels of unemployment. Economic output declined, while consumer confidence and spending decreased. Recession periods often signal major economic shifts. However, sustained economic growth leads to stability and prosperity. Therefore, economists closely track growth rates and work to mitigate recession risks with various strategies. During recessions, central banks and governments typically use fiscal policy, government spending, and taxation and monetary policy control of money supply to stimulate the economy. For example, a government might increase spending to boost demand, while central banks lower interest rates to encourage investment and consumption. 4. Interest rates, the forces shaping the economy. Interest rates are a crucial tool in economic policy and play a critical role in shaping the economy. Interest rates determine the cost of borrowing. High interest rates make borrowing expensive, which can restrict consumer spending and business investments. Low interest rates, on the other hand, encourage borrowing by making loans cheaper, stimulating investment and spending. This, in turn, helps to stimulate economic growth. Interest rates are often used to control inflation. When inflation is too high, central banks may increase interest rates to slow down the economy. Higher interest rates lead to reduced spending and borrowing, which helps to curb inflation. For example, after the 2008 financial crisis, many central banks around the world lowered interest rates in an effort to stimulate the economy and encourage spending. Interest rates also affect exchange rates. High interest rates attract foreign investors, increasing demand for the country's currency, which can lead to a stronger currency. Conversely, lower interest rates may deter foreign investment and lead to a weaker currency. For instance, interest rate changes in the United States often impact global financial markets, as the US dollar is widely used as a global reserve currency. 5. Monetary policy, the power to shape the economy. Monetary policy is the set of tools used by central banks to influence the economy. Central banks control the money supply to achieve specific economic objectives, such as controlling inflation, managing unemployment, and fostering economic stability. The key instruments of monetary policy include interest rates, open market operations, and reserve requirements. Central banks use interest rates to control inflation and stimulate or cool down the economy. By lowering interest rates, central banks can encourage borrowing and spending, which can help boost economic activity. Conversely, raising interest rates can reduce spending and control inflation. Central banks also conduct open market operations, buying or selling government securities to adjust the money supply. When central banks purchase securities, they inject money into the economy, and when they sell securities, they withdraw money from the economy. These actions influence overall liquidity and can help regulate economic activity. Another tool of monetary policy is the reserve requirement, which determines how much money commercial banks must hold in reserve and not lend out. By adjusting this requirement, central banks can directly influence the amount of money circulating in the economy. For example, after the 2008 financial crisis, many central banks, including the US Federal Reserve, used expansionary monetary policies, such as lowering interest rates and purchasing large quantities of government bonds, to stimulate the economy. Similarly, in times of high inflation, central banks may implement contraction policies to tighten the money supply and control rising prices. Understanding these key concepts gives us a deeper insight into how the economy works, enabling us to make more informed financial decisions and better navigate our economic environment. Economics is not just for big corporations or governments. It affects each of us daily. By using this knowledge, you can take more informed financial steps and prepare for a prosperous future.